The inflation that we see, make no mistake, was a policy choice. This wasn't an accident. It was a policy choice. And I have great sympathy for the motivation and the intentions that got us here. I think there was a big mistake, but mostly just the difficult consequences of responsible actions. We're obviously in a very challenging time. Having said that, I'll tell a quick anecdote. In the early 1980s, when I went to work for a large bank in the investment department, my boss at the time said, "Chris, one day when you're writing regular commentary, as I'm sure you will be, you always want to start with now is a particularly difficult time to provide investment advice." So I'm cognizant that while today looks like a particularly uncertain time, when we're assessing financial markets, it's always an uncertain time. Volatility is elevated. So if you look at the VIX, or if you look at implied volatility in bond markets, or you look at the deviation of even very safe treasury bond prices from a model of where they should be, we find that we don't have enough liquidity in the system and that risk is elevated. And when risk is elevated and liquidity is scarce, financial accidents are more common, including large downward moves in capital market prices. And of course, the macroeconomic environment, as all of the listeners know, resembles nothing that any investor that's younger than me, and I'm in my 60s, has any memory of. Those of us who lived through and were professionally active in the 70s and 80s may remember high and volatile inflation environments, along with geopolitical conflict and domestic political polarization. But you really have to go back 30, 40 years to find a historical precedent today's environment. On the other hand, and this is crucially important, yields are much higher, and prices, particularly outside the US, but even in large pockets of the US stock market, are much lower than we've seen in decades. Now is actually a very wonderful time to begin or to increase your accumulation of financial assets. So if you're who's employed and able to save in your 30s or 40s or even in your 20s, now is just a wonderful time to be able to buy capital assets at discount prices. Vanguard would be fine. And create a monthly transfer. Let's start it out with $1,000. I think you can afford $1,000 a month. Start off with a portfolio of 10 different ETFs. I picked the number 10 because I have 10 fingers and toes, and we have a base 10 number system, and 10's a nice round number, but you could use 8 or you could use 12, or there's nothing magic about 10. ETFs that represent a diversified collection of asset classes. I picked about 50-50 riskier assets or less risky assets, or 70-30. There's lots of different ways you could interpret it, but it begins with the most risky assets of equities, US stocks, developed ex-US stocks, and emerging market stocks. That's a reasonable group. Somebody might want to put in US small stocks. I didn't, but that's 3 equity asset classes. Other risky assets I added were REITs and commodities. So that's a pretty full array of equity-like risk assets. And then another 5 asset classes, which are more diversified, including long-term treasury bonds, TIPS, treasury inflation protected securities, real rate bonds, high yield bonds, bank loans, and emerging market local currency bonds. The wonderful thing about diversification is that you can take a portfolio of more risky assets and combine them together, and the overall portfolio is not as risky as the average risk of the underlying asset classes. This is
risk,
the first lesson you learn in a portfolio management class. And then I tell them every month, log on to your brokerage account, look at the new $1,000 that has arrived there because you've created an automatic transfer, and then look at the value of all of the 10 ETFs that you own. Whichever one is the lowest, put the new $1,000 into the single ETF that has the lowest current market value. So you're dollar cost averaging over time. You're also pursuing a value approach. Whatever has done the worst, that's what you're buying. You're buying what's the lowest in market value. And whatever is doing the best, that's not what you're putting the money into. And then I tell them, continue to do this for about the next 50 years or so. And you will have accumulated a very comfortable amount of assets to retire. And then when you retire, reverse it. Figure out how much wealth do I have? How many months do I plan to live? Divide one by the other. Then that's the amount that you want to transfer from your brokerage account to your checking account. Set up that automatic transfer. Go into the portfolio. Look at your ETFs. Whichever one has the highest value, sell that one by the amount of your required monthly transfer. And there's your decumulation plan. Now, I mean that quite literally. That is an incredibly sound investment approach. But more important is the general principles that are embedded in that, including rebalancing, dollar cost averaging, wide diversification, avoidance of emotional short-term timing, etc. And for those people, when prices fall, if you're in the accumulation phase, when prices fall, that's great. You're buying your new purchases at lower prices and higher yields. And if they fall some more, even better. You've got even better opportunities. So again, for people who are accumulating wealth for the future, now that's not the baby boomers, but if you're accumulating wealth for the future, over a long time horizon, the further markets fall, the higher interest rates go, the better it is for you. The inflation that we see, make no mistake, was a policy choice. This wasn't an accident. It was a policy choice. And I have great sympathy for the motivation and the intentions that got us here. I think there was a big mistake, but mostly just the difficult consequences of responsible actions. So let me explain. The reason we have inflation is that we printed and then, I say printed, but of course, I don't use printing presses to create money much anymore. It's all electronic. But we electronically created lots of new money, and this is a crucial point. We then wire transferred all of that money into people's bank accounts. Hundreds of millions of bank accounts in the United States. We injected huge amounts of newly created money, and not just to individuals, but to many corporations as well. Nonprofits, all manner of bank accounts suddenly were stuffed full of newly created dollars. And that creates inflation. And if you could go on in macroeconomic theory and talk about E equals PQ, I would just say, imagine your 8-year-old self asking your parents, if that's where money comes from after looking at the ATM machine, why can't the government just send everybody $100,000 a month? If we sent everybody $100,000 a month, then we'd all be rich. Of course, we wouldn't all be rich because the amount of goods and services that are available to consume isn't increased by transferring money into bank accounts. And our consumption is limited by the aggregate amount of production. But what we had was a dire crisis, a pandemic. And in that pandemic, there was a fear, and I think a very reasonable fear, that the human suffering that would result from that pandemic would fall disproportionately on the worst off in our society. And in an effort, a humanitarian, well-meaning effort to prevent disproportionate suffering from those least able to afford it, we distributed lots of cash, lots of new money to everybody's bank account. And it wasn't very targeted because you can't target it. The government doesn't know that much, right? The government can't figure out who are really the people needed it and who are the people that don't need it, and just target it to the people who really, they don't understand that. So they just wanted to flood everybody with money so that the people who really did need it mostly got some of it. And then lots of other people who didn't need it also got it. And that's what we did. And it was a humanitarian impulse, and I get it. But during the pandemic, we closed down lots of parts of the economy, not just in the United States, but the whole world. So the aggregate amount, the aggregate supply of goods and services was going down. There's no way that we can all not reduce our consumption if the aggregate amount of production has all gone down. So simultaneously with aggregate real production of goods and services declining, we flooded the system with money. That's why we got inflation. And the problem that now we have to deal with inflation, and inflation tends to be self-perpetuating. Once you've got it up and going, the prices are going up, fuel costs are going up, cost of food, groceries is going up. Then people expect to have higher wages. And because people get higher wages, then they can afford more. They can afford more in nominal terms, of course. They're not getting more, they're not actually getting more gallons of gasoline. They're not getting more groceries. They're just paying higher prices, and that gets some momentum to it. I said there was a mistake, and there was a mistake, and it was the mistake of the Federal Reserve. And it was this Fed saying, and they were very clear about this, we're going to change the way we do monetary policy. We're not going to forecast future inflation. And when we forecast that future inflation is at risk of rising, perhaps because unemployment is lower than its natural rate, and nobody knows what that natural rate is, just like nobody knows where the equilibrium level of interest rates are. These are theoretical concepts, not easily measurable quantities. But the Fed had always had a forward-looking. They have models and forecast where things were going, and then they would act preemptively and ahead of time because, of course, there are long lags in policy. So famously, the Fed is supposed to take the punch bowl away from the party before the party gets too raucous. What the Fed said was, no, we're not going to do that. New change, new policy, until we see actual inflation rising, not just a forecast of inflation rising, until we see inflation actually rising well above target, and we see employment at risk, we're not going to tighten. So what they did was say, we're going to err on the side of having inflation get above target. And what did we get? They erred on the side of inflation getting above target. Now, I want to go back and emphasize, don't be too cruel to the Fed, because that was a small part of the deal. The big part was flooding the world with money as the humanitarian response to the pandemic. That's really what caused inflation. Now, a next question you might ask is, where do we go from here? And I think people are underestimating the probability of more persistent and higher inflation. You might say, look, the Fed retired its silly word transitory, and everybody gets that it's not transitory. I'll tell you what, everybody gets that it's not transitory except pricing in the bond market. Break-even inflation, the bond market's tradable price for where CPI is going to be, is like about 2.5 for the next 10 years, below 3 for the next 5 years.